Is the U.S. housing market still a safe bet, or is it teetering on the edge of a downturn? Let's evaluate some brand new data, expert forecast, and real life trends to see if investing in real estate still makes sense, or is it time to hit the exits? Now, I'm sure you're saying it, you're thinking about it. Haven't we been hearing about a possible crash for years? Just ask any crash bro. It's been happening for years. But the story is more complicated than a simple boom or bust scenario. We've got research from multiple angles, migration patterns, active listings, and even 2025 price forecasts to give us a clear snapshot of what's really happening out there. Why does this matter so much? Well, real estate isn't just about owning a place to live. It's about building wealth, diversifying investments, and securing financial stability. If you're a homeowner, a potential investor, or just plain curious about where the markets are headed, this data could help make you some of the most important decisions of your financial life. But here's the kicker. Some markets are on fire and others are cooling off. So if you're thinking it's the same story everywhere, think again. We're going to separate fact from fiction and help you get ahead of the trends that could shape your next move. By the end, you'll see whether the numbers back up the idea that U.S. real estate remains a stable path to long-term growth, or is it just time to rethink the whole strategy? Do me a favor. You're not going to want to miss this. Buckle up. Let's get started. The biggest driver behind any hot or not so hot housing market is migration. Who's moving where and why? Over the past few years, we've seen huge shuffle of Americans picking up and heading to states like Texas, Florida, and the Carolinas. But guess what? That pandemic boom for places like Austin or Tampa isn't quite the same story anymore. Now, Texas and Florida are still gaining population. There's no surprise there, but the pace of that influx has cooled off compared to those wild pandemic peaks. Think about it. During the lockdowns, remote workers were sprinting towards warmer weather and lower taxes. But as more offices reopened and mortgage rates climbed, people are pressing pause on those big cross-country moves. Meanwhile, states like California and New York are still seeing folks head elsewhere, but it's not the flood it once was. High taxes, high cost of living, and a pushback to in-person work are keeping some people on the move, though the trend isn't as dramatic as it was before. So what does all this movement mean or slowdown mean for real estate? In places still drawing in newcomers, we see more demand for homes. The demand can keep prices stable or even push them up, especially when inventory is tight. But in certain boom towns like Austin, where a ton of new listings have popped up, right as migration has cooled, home prices have felt the pinch. When the flood of outside buyers slows down, it's local wages and local demand that have to pick up the slack. What's interesting, if prices shot up beyond what local incomes can support and those out-of-state buyers aren't rolling in like they used to, what happens next? Well, spoiler alert, it's not always so pretty. Before we jump to conclusions, let's see what the numbers say about inventory and how that's shifting the whole power balance between buyers and sellers. You know how many homes are actually up for grabs right now. Believe it or not, watching those numbers can tip us off about where prices are headed next. You should believe it. It's pretty obvious. Nationally, the number of homes on the market, often called active listings, has been creeping up. We're seeing about a 26% jump over the past year. That sounds significant. Well, don't get too excited just yet because we're still well below where we stood in 2019, before anyone had heard of social distancing. In other words, it's rising, but we're not anywhere near the oversupply crisis that we once had. To me, this is actually pretty fascinating. Some states have roared back to or even above their pre-pandemic inventory levels. Think about states like Florida, Idaho, Texas, while states in the Midwest and the Northeast are still super tight. So why does that matter? Because when a region has more listings, buyers have more choices. And when buyers have more choices, they have more power in negotiations. That can put the brakes on wild price hikes. But in areas where inventory is still below normal, places that haven't seen that wave of new listings, sellers often are still in the driver's seat. If there aren't enough homes for everyone, the competition remains fierce, and that can keep prices elevated. That seems pretty obvious. But here's the kicker, though. As inventory goes up in certain markets, looking at you, Austin, prices tend to flatten or even dip, especially if mortgage rates remain high. But don't write off all these spots completely. A lot of them still have strong job growth or attractive lifestyles that could spark another round of demand down the road. That's why inventory is so crucial. It tells us we're dealing with short-term slowdown or whether we're dealing with something more long-lasting. So do these rising inventory numbers spell doom for everyone, or is it a sign that things are simply finally leveling out? Now, the big question is, where are prices headed next? Not everybody agrees, as you can imagine. On one side, we've got Zillow predicting that the U.S. housing prices will climb, or U.S. home prices will climb about 2.9% in 2025. Their reasoning? Simple. Low inventory still lingering around, plus the possibility that mortgage rates might actually ease up a bit, which could bring more buyers out of hiding. They see most markets holding steady or rising, but not with the same rocket fuel pace we saw during the pandemic. I think we all can agree to that. Nationwide, locally, it is not like it was in the pandemic. And on the flip side of that, Moody's is a bit more bearish. They're actually forecasting a slight decrease of 0.4% dip in prices. So they're expecting more homeowners to finally list their properties because maybe of job relocations or life changes like divorce, death, those type of things, right around the time mortgage rates come down. According to Moody's, all of these extra listings could outpace demand, which might send prices slightly south in some markets. Now, remember, these are national averages. If you're in Rochester, New York, you might see prices going up like they are right now. While if you're hanging out in Punta Gorda, you could be watching prices flatten or even drop further. The lesson here is that real estate is local. One market's gold mine might be another market's ghost town. So with so many competing forecasts without getting whiplash, the short answer is keep your eyes on inventory. The data shows a clear link between supply levels and whether prices are going to rise or they're going to sink. But let's not forget about interest rates, job growth, and local economic vibes all play their part too. So again, sort of the question is, do we strap in for a modest game or prep for a mini sell-off? Before you pick a side, there's one more piece of the puzzle that you need to see. And we're going to break out the shifting inventory forecast for 2025 and how that could make all the difference on whether or not your local market thrives or dives. I've talked about migration, talked about how supply levels impact growth, price growth, and we've even peeked at the experts' 2025 price prediction. So now let's tackle one of the biggest pieces of the puzzle, where inventory is headed next year and how it could flip the script on buyers and sellers alike. Housing Wire says you could see a 13% bump in the number of homes for sale in 2025. Bright MLS is calling for a 12.8% uptick, and Realtor.com is a smidge lower at 11.7%. Put all those together, and the average forecast is for around about 12.5% for active listings increase in 2025. If that happens, we're looking at roughly 1.07 million, so just under 1.1 million homes on the market by next November. That's shy of pre-pandemic levels, about 6% below the 2019 mark, but way above the lows we saw at the height of the pandemic boom. And what does that mean for everyday buyers and sellers? Well, for one, more inventory could mean less power for sellers who've enjoyed sky-high offers over the past few years. If you're a seller in a market where listings are piling up faster, they're getting scooped up, you might have to actually sweeten the deal a bit. Think about price cuts, seller concessions, something to make it more marketable. But don't panic. It's not like we're expecting this flood that crashes prices overnight. Even with that 12.5% boost, we're still not in a buyer's wonderland of the 2012 or anything like that, not even close. The real kicker is how this shift plays out region by region. In some Midwestern and Northeastern areas, supply is still tight. So don't expect a huge buyer's market there anytime soon. But in parts of the Sun Belt, like the Gulf Coast regions we've been watching, added listings could quickly flip the dynamic, especially if mortgage rates come down just enough to tempt more homeowners into selling. Now remember, even a small change in interest rates can unlock a wave of new listings from people who have been holding tight to that 3% mortgage rate, that lock-in effect, right? It may loosen the belt a little bit. And more listings on the market, especially in areas where home builders are active, can stack up in a hurry, giving buyers more leverage. So is 2025 the year we finally see a balanced market, or is this just another baby step back towards normal? The honest answer, it just depends on where you live. But one thing's for sure, when supply goes up, it puts a lid on the kind of scorching price appreciation we saw during the lockdown era. And that may be just what the market needs to find its footing. So after digging through migration trends, inventory stats, and all the 2025 forecasts, we come back to the big question. Is real estate worth your time, your money, and your energy? Or are we just fooling ourselves into another bubble? The short answer, real estate looks like a fairly stable long-term investment like it always has. But it's definitely not the free-for-all it was during the pandemic boom. Let's break it down. Demand shift and migration. States that saw a tidal wave of newcomers like Texas and Florida are pulling in buyers, but the flow has slowed. That's cooling price surges, but not collapsing them by any stretch of the imagination overall. Inventory levels, yes, inventory is rising in some regions, which is giving buyers more leverage than they've had in years and years past. But keep in mind, we're still below where we were in 2019 overall. The translation, supply isn't so high that it's likely to tank prices, definitely not on a national scale, but just enough for you to maybe tap the brakes on some sort of runaway growth. Price projections. Even the doom and gloom forecasts aren't calling for a massive drop, and bullish ones aren't promising insane gains either. We're more or less likely at a slow, steady movement up or down, depending upon your local conditions. The crash bros, I don't think are going to see any sort of significant crash anytime soon. Lock-in effect. Thanks to the low mortgage rates many homeowners locked in at, folks are not rushing to sell. More than 70% of homeowners are below 4%. That keeps resale listings lower than they might otherwise be. And if there aren't a ton of homes to choose from, there's a natural floor under prices. Of course, these are risks. Affordability remains a nightmare in most markets. And if mortgage rates swing wildly, the equations can change fast. So pandemic boomtowns might still see deeper corrections, especially if they soared way above what the local incomes can support. But a coast-to-coast crash? I don't think so. The data just is not there to back it up. If you're deciding whether to jump in today or hold off, consider your local market and your personal situation more than any national headline. Overall, the numbers suggest real estate is still a decent way to build and preserve wealth. Don't just expect overnight riches. In some places, it's full steam ahead. In other places, again, it's time to pump those brakes. It's all about where you're looking and what you're planning to buy or to sell. And especially if you're going to utilize a mortgage to maximize your gains if you're an investor, the compounded effect is significant and still makes sense. We're going to wrap up with some closing thoughts on how all these factors tie together and a few tips on what to watch for next. If you've been wondering how best to navigate this market, stick around. I'm going to bring it all home. 4 huge factors shaping the U.S. housing market right now: migration, inventory levels, expert forecasts, and your local dynamics. Put it all together, and the picture is pretty clear. We've moved past the frenzy of the pandemic boom, and what lies ahead is a market that's balanced, but not crashing. Boring, probably yes, but not crashing. And here's my final takeaway. Real estate is still a powerful tool for building wealth or diversifying your investments. But strategy matters. Gone are the days when you could just plunk down an offer anywhere and watch your equity just shoot through the roof. The data we've seen shows that if you're smart about where you buy and you keep a close eye on local supply and demand trends, you could still come out on top even in a slower, more cautious environment. Probably not nearly as sexy as it once was. First, keep watching local inventory levels. A surge in homes for sale could tip the scales in your favor if you're buying or nudge you to price competitively if you're selling. Second, pay attention to interest rates. A small dip could bring out more competition, but it could also open up the doors for you if you're locked out by high monthly payments right now. Second, pay attention to interest rates. A small dip could bring out more competition, but it could also open up doors for you if you're locked into an incredibly low rate and you're too worried about that change. So pay attention to interest rates. That's going to be a huge factor. Third, Study job growth and economic stability in the area you're considering. It's not just about getting a good deal today. It's about ensuring there's enough demand in your market to sustain or grow home values over time. Just because an Amazon plant is building or Amazon's building a distribution plant doesn't mean that they're actually going to utilize that plant. Pay attention, do your research. If you feel overwhelmed, that's completely normal. Trust me, most people are. The real estate world can be a roller coaster, but it's one that if we can all understand if we break it down step by step. Whether you're buying your first home or you're adding to your portfolio or just trying to figure out whether to move across the country, the more informed you are, the better moves you'll make. If you found this helpful, do me a favor, like and subscribe, share. I've got plenty more tips coming with data-driven insights, and I've got plenty of videos in the past that I would encourage you to take a look at. Everything from best practices for negotiating to how to spot an up-and-coming neighborhood before prices skyrocket. So make sure you're subscribed, hit that notification bell, and share this with your friends who's in the market. Thank you so much. Remember, knowledge is power, especially when it comes to real estate. Until next time, my name is Darren Hunter, and that's another Guaranteed video.